So we'll just take 30 minutes or so to have a quick panel session, maybe 25 minutes time we've got. Conrad, we have a guest, Conrad, from Funding Options. You may want to introduce yourself. Or maybe that's
yeah, just very briefly. I'm from Funding Options. I'm the only one who hasn't presented tonight. So Funding Options, just to introduce ourselves, we are a technology-driven company that helps businesses to seek finance from a range of products and providers. So we're not a finance provider ourselves, but we do build some fairly deep online technology to support that.
great. So this format is basically an open discussion. So I'll throw it open to questions, and then everyone on the panel gets a chance to have their say and so on, and we just take it from there. So does anyone want to start with the first question?
Hi, my name is Sid. One of the questions I wanted to ask, a lot of the panelists earlier spoke about how it's been mostly regulation and the fact that banks are now facing increased regulation that's creating the opportunity for alternative finance providers. How do you see the role of regulation for your businesses, and where do you think it'll become a hindrance, and where do you think it can actually help provide some sort of shape or structure and help your businesses? So how do you approach regulation on a strategic basis?
So from a Wonga perspective, we welcome regulation. What we've done is we have effectively cleaned up an industry that probably had a bit of a dark side, and I think regulation helps legitimise a lot of the things that we've done, and if more businesses do it our way, I think the whole industry will be cleaned up much more. From a business perspective, the regulatory side is not as tight. We aren't under the same kind of structures as the banks. But I'm sure it will come, and again, so long as it's done the right way, we'll welcome it, because if you do things the right way, it shouldn't be an issue.
Yeah, I think a really important point to make is that I think people often overestimate how much the business finance market is regulated in its current form. So generally speaking, if you're say an invoice finance provider, you don't have any regulation whatsoever if you're lending to pure businesses over 25k. So generally speaking, there's a tendency to overstate that. Large banks have a general obligation to treat small businesses fairly, which is a principles-based regulation. But we don't really operate in a regulatory regime at the moment, per se. What we've seen, of course, is we've seen the peer-to-peer lending market say that they want regulation to come in. I mean, my perspective on that is to be careful what you wish for, because whenever you think about regulation, you need to remember that a civil servant, if something goes horribly wrong in a market that they've been asked to regulate, the downsides are huge. If they stifle a bit of innovation, there's no downsides for them. So I'd be careful what you wish for is always the case in any kind of regulation, particularly in finance, I think.
The only thing that I would add, it's actually not that regulation is bad, it's about the uncertainty of regulation. In our space, on the business side, there's actually a lot of uncertainty. If you go into sole traders, there's a lot of uncertainty because they fall under the Credit Consumer Act. Clearly, as a sole trader, you are not a consumer, yet you fall under a lot of the regulation that apply to consumer and that don't really make sense for the specific activity that they are doing. So it's more about uncertainty than regulation. So I think generally regulation is well thought of, in particular if it's new, but it takes a long time for regulators to come up with it.
Yeah, I'd certainly echo the last point. It does take them a while to come up with regulation, and we have taken the approach that we brief early and brief often. So we've taken the view that we keep them close, we help them understand what we're doing and how we do it. And from day one, we have acted as if we are regulated.
Do you have another question?
How much do you think the opportunity of peer-based funding and the other things that are funding a number of your operations are that there are zero returns in almost any other kind of investment at the moment? And how much of this is a genuine, fantastic business opportunity for investors?
Well, I'll pick that one up, as we're the one that represents the kind of, the money which has been liberated from bank accounts which aren't earning money elsewhere. Clearly this is a big factor. If you're faced with if you're faced with your money losing your money, you are going to be keen to find a place where it is going to make you money. Now, net annualized returns at the moment with us are around about the 17% mark. if you were in the best rated business, if the best rate of return that you're getting in any bank account right now doesn't touch that. So you've got to remember it's risk rate of return. It is, you're taking a risk with your money, you seek to make a return, you're looking for a well-run trading platform with low default, but you've got to factor that into your decision making. So there is some effort required to make that return. And so what I would say is people are attracted to two things. One, they're going to make a return, and two, they are going to have a level of control over the return that they make. Those are two attractive things to the people who've been on our platform.
And I think one comment I'd make is that certainly from what I've seen in the working capital side of things, there's not actually that much pure peer-to-peer activity. So in other words, individuals like you and me. Generally speaking, what you see in the working capital finance market, to the extent there's independence, you see a couple of things. You either see institutional funds or high net worth, which you're seeing a lot about in receivables exchange, I think you guys, and market invoice. And then the other thing you see is back-to-backs. You see a lot of back-to-backs. So that basically means you put together, say, £1 million of equity, you then get a back-to-back facility with a bank of £10 million, and then obviously you get wiped out before the bank's money. And the reason that makes sense is because the yields are so high in this market, because it's revolving finance. So you can get a back-to-back facility, let's say, of 5%. Well, guess what? If you can make 15%, you're making a decent return. There's really not that much peer-to-peer in this market. In other words, individuals like us.
Well, we're not a peer-to-peer lender, but I can give you the reason why we're actually, for the time being at least, decided not to pursue that way. We're very much focused on funding businesses, and as a small company, that's already a very big task to refine and get an algorithm where we feel comfortable to take the risk ourselves. Also, we are a very high velocity business, so we aim to fund our customers within minutes rather than days or weeks, making the auctioning process that your platform has quite cumbersome for us, because our value proposition is speed. Speed is here much higher than in banks, but it's still not, for some of our customers, sufficient to really conduct their business. So peers become for us very attractive as an additional funding source to diversify our funding mix. And we think we could go down this way and eventually cut our funding costs. And we may do this in the future, but for the time being it will come with a lot of additional operational burden that we're currently not facing, and not as much benefits as for obviously a peer-to-peer platform that has this as a pure business model.
I probably shouldn't have a comment on this one, but I think the one important thing here is, if deposit rates go up, lending rates go up as well. So if it works in a free market model, it's still going to carry on regardless of what the rates are.
I was just wondering, for your companies that are not super big banks, how would another financial crisis affect you compared to the big banks?
I'll have a first go, but I don't lend, but I'll give my perspective on that. I think one of the themes that hasn't been explicitly stated, but it's been implicit in the presentations today, is ultimately working capital finance is all about data, okay? And we've seen it alluded to, but this is really, really important. An innovative working capital platform is one that can basically find a live data source about the transactions of the business, because that's what you're financing. So what we have is, Wonga, for example, is financing live transactional data in terms of the eBay and the Amazon online platforms. Wonga, well, guess what, they ask for your bank details when you apply for finance. So they have access to some very live transactional data there. Other areas where you have credit card receivables, we haven't talked about today, but payment card receivables is a live transactional data source. So you've got on-deck capital that Wonga actually came close to buying very recently for $250 million. So there's some really interesting models, but the key thing that links them all is they found a new live transactional data source. And the reason I say that before I answer your question is because the whole predication of these models being sustainable is that they found a competitive advantage in that data. okay, which means that they can profitably lend where others can't. So they would argue, and I think with some justification, that they can probably actually sustain a financial crisis situation because they found a niche to lend into. And I think that's where the sustainable advantage comes from.
Absolutely endorse that. I think that's absolutely right. Not only do we gather huge amounts of data and sort of reel that into our trading platform, we're a trading platform. We gather huge amounts of data every time a transaction happens. As I described to you, just the one example I think I gave, which is of an auction going live at noon and closing at 5 and having 84 bids on it. Every single one of those bids gives us data, because a bid comes in at the top end that the buyer is prepared to invest at and has a floor. So we can track each one of those bids to understand where it came in, so what was the initial appetite and what was the floor appetite. Every single one of those bids can be, if the buyer wants it to be, fractional. So you can bid for 5% of the auction or anything up to 100% of the auction. So we, just by the very fact of what we do, we generate huge amounts of data. And it's that which gives us confidence to track each and every one of the members of our platform, and then allows them in turn to have confidence in selling and confidence in buying.
I do agree that we would probably do better, and I think partially this is because we are much smaller and more flexible, and because we have this data to choose our customers more carefully. But if you own the market, then obviously you have similar risks. So if we were to become very, very large, all of us, and would rival the Barclays, HSBC, or so forth, it becomes more difficult to turn all of the customers away, where our data would say cleverly, you shouldn't lend to them. We would probably have to increase also the amount of people that we were taking, and hence would have similar issues. But still, I think where we are better than lots of the larger companies, we are much, much, much more cost effective. And that also allows us to factor in companies that a bank wouldn't touch, which is at the very low end. You know, in my case, which is very different to the other companies, we're investing in growth companies, but they only may do £50,000 in revenues today. Next year it may be 150, but from a bank's point of view, they wouldn't really see a business at all. So our lean cost base and data access helps us to give them funding where they just commercially wouldn't even have a look at it.
I don't think it's if we become this big, I think it's when we become this big. From my perspective, I think a business like Wonga will survive better outside of the financial crisis, because the appetite for people to borrow and know that they can pay it back increases significantly. So as the market gets better, you know, we get really excited about our prospects. The fact that we've grown like we have in the environment so far is great, but we see it as much better. I think another financial crisis will provide us with significant opportunities as well. And if I use an example, so one of the case studies that we're putting together at the moment is a health and safety business that works with big development firms. And clearly when there was the threat of another dip 8 months ago, this business, basically, all of their activity kind of dried up as all the development companies kind of went on hold and kind of stopped what they were doing. They went to their bank, and the bank said, well, you're involved in development, sorry, we're not going to lend you anything. So yeah, we provided them a small loan, not a substantial loan. It's only a small business, I think there are 3 or 4 people there. And that allowed them to survive for about 4 months or so. Subsequently, the market's looking a bit better now, and they are inundated in opportunities, and they've paid the loan back, and we probably won't see them for another 6 months until that they need funds again to help out. And I think it depends on how you set up your store, because we are able to make decisions very, very quickly using a lot of data. in a very low-cost manner, we can support businesses where the banks simply cannot or won't because they're scared of the economic conditions.
Okay, we have maybe one more question.
Hi there, Tim here. To the guys that are lending, when you were starting out, how did you scale your funding with demand? So how did you, especially for Wonga, I think?
I can't really talk about Wonga.com because it is kind of before my time, but Wonga For Business, I had the luxury of kind of starting a business within another business that had quite a lot of cash to support what we were doing. We actively took the decision to start quite slowly and build it up. Because of the volumes of the amounts that we were lending, we didn't want to kind of go out and lose a bunch of money and learn from that, which is kind of what we did with Wonga.com. You know, we threw out the old way of underwriting, lent to lots of people, and then learned from how they performed, and then built the algorithm. With business, because we had bigger amounts, we couldn't afford to do that, so we were much more cautious. So for us, it was relatively easy to obtain funding. So probably slightly a bit of a fraud, I don't know.
Well, you start with your own money, so you're quite restrictive in the very beginning, because obviously you have choice and you have a limited amount of pool of money. Then you ask the wife, then your parents, and your friends, and then at some point you may have found an investor who's also putting something in, and then the whole game kind of restarts until you get new investment in. But from our perspective, we are constrained by the funds that we have access to, and if we had more capital, we could obviously put a lot more capital to work. So it is kind of, you know, step by step. We get capital, we lend it out, we grab more capital from various sources, and then we get another kind of larger capital round done, and then, you know, the whole game starts again. So it's very capital driven. You know, you get a lot of demand, and you can only supply as much as you have, and you kind of have to be quite prudent about this.
For us, because we're an auction site, we need to balance supply and demand. And an awful lot of our time is spent on making sure that SMEs are getting a good cost of finance and that buyers are getting a good return. So you have to grow both sides of the marketplace in harmony. And that's a balancing act, but from our costs of finance and from our rates of return, it's one that we're managing okay at the moment, and we now just have to simply continue to scale that. We get a huge number of inbound inquiries on the investor side. We made the huge mistake of appearing in the Sunday Times a couple of weeks ago, and the huge influx that we had of people applying to become members of Platform Black on the investor side, to be buy-side members, was quite incredible. And then we go and do something on the sell side, and then we have a huge influx of people from SMEs, or you know, a broker brings another 20 opportunities to us. For us, it's about balance, and it's about quality. We're very keen to make sure that we continue with auctions closing and very low, at the moment, 0 rates of default. It's balance.
Alex Croker, working Mergers and Acquisitions at Grant Thornton. So you're in an industry that's largely been built by demand. So there's a demand there, and you're formed. You often find in a new industry like that, there's a cyclical pattern. You get a lot of entrepreneurs involved at the start. There's a period of consolidation after that. The larger players come in, and you get the efficiencies that grow out of that. What I wanted to know is, where do you see this industry in about 10 years' time? Or where do you see this industry going forward?
Oh gosh, I get to answer that first because I've got the mic. Here's a terrifying stat for you. 90% of Britain's SMEs currently exclusively get all of their financial services from 5 banking groups. It's an oligopoly. Where I see us going in 5 years, in 10 years, is much more competition in the marketplace, much more openness, much more transparency. Now, obviously, choice brings 2 things. It brings a benefit and it brings a burden as an SME. The benefit of choice is you have choice. The burden of choice is you've got to make a decision. So I expect and I hope that Britain's businesses will be much more capable and much more confident in making those decisions. And switching this back on to Grant Thornton, which are quite a considerable accountancy firm, I expect you and your colleagues to be advising Britain's businesses on where best to get their finance.
I think companies like ours contribute in innovation. Also, that will be applied in the wider financial market. So, innovation always comes from very small companies, and I think some of what we do will ultimately end up in larger organizations, either by us replacing them, as you correctly pointed out earlier, or them integrating some of the proprietary knowledge that we develop in their own system. So I think in 10 years' time, you will have a very different landscape from a technological point of view, where access to data will become ever better, and where we as companies have found ways to not only make it accessible, but also to make a better analysis on the back of that.
Yeah, so my take on this is that, well, I won't use the O word, we have a concentrated banking market in the UK, and the outcome of that is you have very monolithic propositions for small businesses. So the banks don't do much segmentation. Their segmentation tends to be you're very small, you're smallish, or you're medium-sized. When you think about Britain's small business population is B2B businesses, B2C businesses, it's growth businesses, it's small businesses. There's a whole range of diversities and segments and sectors. What I think is going to happen, I think this is an immensely positive thing, is you're going to see innovative financial services providers, not just in finance, but in a whole range of areas, beginning to pick off niches with something that's relevant to their needs. So online sellers, an absolutely classic example there. The existing banking model is just not set up for that. They don't get it. They don't realise how many of their customers are beginning to play around with eBay and Amazon, for example. So what you're going to see is basically new players nibbling away at small niche segments with more relevant services. And some of those niches, of course, are going to be businesses that want a traditional banking relationship. So you get Handelsbank and Aldermore. Some of them want that. Some of them want a pure online service. So what I think you're going to see is picking away at the margins with micro-segmentation. So more choice, more relevant services is the future of small business banking. But still, to be clear, I think don't underestimate the ability of the large banks to react. Right? You know, they are quite numbering, to be candid, but there are people who are going to build services and technologies that will help them adapt to that new world.
I agree with the last point, because I think some of them are already doing that. You know, some of the products that, say, Barclays have brought out recently are quite interesting, very anti-bank. Yeah, 10 years is a long way away. I think what will actually start to happen is, and it kind of goes along with what you just said about kind of around the periphery, I think we still have to pay our cash into a business's bank account. We still have to use old school ways of extracting money out of their bank account to take lower payments. And I think what will actually start to happen is you know, the next generation of entrepreneurs will start looking at those systems and finding ways to do it in a much better, much more harmonious, much more attractive way from the small business perspective, and for the likes of businesses like us. I mean, if I use an example, direct debit in this country, you have to be sponsored by a bank in order to do direct debit. So they have a monopoly and they can control
innovation. So I think you will start to see some really, really cool ideas and concepts and businesses come out around that sort of area, which I'd love to see a world where you don't need bank accounts anymore. There's a different way of transferring value. And it could be less than 10 years away.
Thank you.
Okay, guys, I'm going to close the panel then. Thank you all very, very much.